At 5:23 on a Thursday morning in late October, the kitchen light in a split-level home outside of Columbus, Ohio, casts a pale yellow glow across a laminate countertop where Gerald sits with a printed Social Security statement spread flat beside a half-empty coffee mug. The number near the bottom of that statement reads $2,814 per month at age 62, and right next to it, a second column shows $3,948 at age 70. And Gerald cannot stop his eyes from bouncing between those two figures like a pendulum he does not know how to stop. His reading glasses sit low on his nose, and the hum of the refrigerator is the only sound in the house at this hour, a low electric drone that matches the tightness in his chest. He picks up a pencil, writes a subtraction on the margin of the page, then sets the pencil down without finishing. The 8-year gap between those two numbers feels like a canyon he is supposed to cross with no bridge and no map. His left hand hovers over a calculator on the table, fingers curled but not pressing a single key, as though the act of computing would make the decision real in a way he is not ready for. The choice Gerald faces is not simply about when to file. It is about how much income he will lock in for every remaining year of his life, and the permanence of that lock is what makes his breathing shallow. He closes the statement and pushes it to the far edge of the table, but the numbers stay behind his eyes. The problem is not that Gerald lacks information. The problem is that the information he has makes two opposite paths look equally reasonable. Gerald is not unusual. The majority of Americans approaching their early 60s confront this exact decision with the same spreadsheet dread and the same competing instincts pulling them in opposite directions. What most of them do not realize is that the claiming age question is only the visible surface of a much deeper strategic layer that the Social Security Administration never explains on its website. This is the layer that determines real lifetime income. It involves tax brackets, Medicare premiums, and spousal coordination that interact in ways almost nobody models correctly before filing. And over the next few minutes, you are going to see exactly how that hidden layer works and what it costs when you ignore it. You will understand why claiming Social Security at 62 can quietly cost a married couple over $180,000 in lifetime after-tax income compared to a coordinated delay strategy. You will see how each year you wait between 62 and 70 increases your monthly benefit by roughly 8% per year through delayed retirement credits. You will learn exactly how your other retirement accounts, your 401k, your Roth IRA, your taxable brokerage, connect to your claiming decision in a way that most retirees never map out. And you will have a concrete framework for running your own numbers before you sign a single form. You do not need a finance degree to follow this. You need 20 minutes of honest attention and the willingness to question a decision you may have already half made. Retirement is a fundamentally different financial environment from the decades you spent working, and the shift is not just emotional, it is structural. During your career, money moved in one direction. Your employer paid you, taxes came out automatically, and whatever remained went into spending or savings. In retirement, that pipeline reverses, and suddenly you become the one deciding how much income to generate, from which accounts, and in which order. If you have recently retired, or you are standing on the edge of it right now, this structural reversal applies to you directly, and every dollar decision you make in the next few years carries weight that compounds for decades. Most retirees have at least 2 and often 3 distinct types of accounts, and the tax treatment of each one is radically different from the others. Think of your retirement income strategy as a recipe. Every ingredient, Social Security, your traditional IRA, your Roth, your brokerage account, has a specific flavor profile and a specific reaction when you combine it with the others. Use too much of one ingredient too early, and the whole dish turns bitter in ways you will not taste until years later. The art of retirement income is knowing which ingredient to reach for first, how much to use, and when to hold one back so the final result comes out balanced. Your traditional 401k and traditional IRA are accounts funded with pre-tax dollars, which means you received a tax deduction in the year you contributed, and in exchange, the IRS treats every single dollar that comes out as ordinary income in the year you withdraw it. That ordinary income stacks on top of any other income you have that year: Social Security, part-time work, pension payments, dividends, and the total determines which federal tax bracket you land in. If your total taxable income pushes you from the 12% bracket into the 22% bracket, Every dollar above that threshold gets taxed at the higher rate. This is not a theoretical risk. It is the mathematical default for anyone with a sizable traditional balance and no withdrawal strategy. The IRS does not care whether you planned the withdrawal or whether you needed it. The tax is the same either way. Your Roth IRA and Roth 401k work in the opposite direction. You funded them with after-tax dollars, money that was already taxed before it went in. And in return, qualified withdrawals in retirement are completely tax-free and do not count as income on your federal return. That distinction matters enormously because Roth withdrawals do not push you into higher brackets, do not trigger Medicare IRMAA surcharges, and do not cause more of your Social Security to become taxable. When you pull money from a Roth account, the IRS essentially pretends the withdrawal never happened. That invisibility is what makes Roth accounts so powerful in a coordinated retirement income plan. Your taxable brokerage account sits in a third category, where the tax treatment depends on what you sell and how long you held it. Long-term capital gains on investments held longer than a year are taxed at preferential rates of 0, 15, or 20%, depending on your total income, while short-term gains are taxed as ordinary income, just like your traditional IRA withdrawals. Dividends from this account also show up on your tax return and can nudge your income higher than you expected. The interplay between these three account types is where the recipe either comes together beautifully or quietly falls apart. The majority of people approaching Social Security assume that the decision is binary. Claim early at 62 and get a smaller check, or wait until 70 and get a larger one, and that the right answer depends mostly on how long you expect to live. That longevity framing feels logical because it turns the question into a simple break-even calculation. If you live past a certain age, waiting pays off. And if you die before that age, claiming early was the better bet. The reason this intuition is so hard to shake is that it reduces an enormously complex decision to a coin flip about lifespan, and coin flips feel manageable. Here is the thing. The real cost of claiming early is not just the reduced monthly check. It is the cascade of tax consequences that follow from needing to withdraw more from your traditional accounts to cover the income gap during the years you could have waited. If you claim Social Security at 62 and your benefit is $2,100 per month instead of the $3,700 you would have received at 70, you need to pull an additional $1,600 per month from somewhere. And if that somewhere is your traditional IRA, every dollar of it lands in your taxable income column. For a married couple filing jointly in 2024, the 12% federal bracket ends at $94,050 of taxable income, and the 22% bracket runs up to $201,050. So an extra $19,200 per year in traditional withdrawals can push you across that line and raise your effective rate on thousands of dollars you did not need to touch. That bracket jump does not just cost you money once. It resets every single year you remain in the higher range. The second invisible consequence hits your Medicare premiums through a surcharge called IRMAA, Income-Related Monthly Adjustment Amount. Medicare Part B and Part D premiums are means tested, meaning your premium goes up when your modified adjusted gross income exceeds certain thresholds, and those thresholds are based on your tax return from 2 years prior. A married couple whose combined income crosses $206,000 can see their Medicare Part B premium jump from the standard $174.70 per month to over $400 per month per person. If you are looking at your own withdrawals from the last 2 years, check whether your combined income landed close to an IRMAA threshold, because you may already be paying more than you needed to. That is not a one-time hit. IRMAA surcharges recalculate every year, so sustained higher withdrawals lock in higher premiums for as long as your income stays elevated. The third consequence is the one that blindsides retirees most often, and it involves the taxation of your Social Security benefits themselves. If your combined income, which the IRS defines as adjusted gross income plus non-taxable interest, plus half of your Social Security, exceeds $44,000 for a married couple filing jointly, up to 85% of your Social Security becomes taxable as ordinary income. Stop and picture this happening to your own Social Security check. If you have been pulling from your traditional IRA without tracking your combined income, you may have already crossed that $44,000 line and pushed a large portion of your benefits into taxable territory without realizing it. That means the very withdrawals you made to supplement your Social Security income can trigger a tax on the Social Security itself, creating a feedback loop where each additional dollar withdrawn effectively costs more than $1 in total tax impact. This cascading effect is what financial planners call the tax torpedo, and it is remarkably easy to trigger by accident. Gerald, sitting at that kitchen table in Ohio, had claimed Social Security at 62 because the money felt urgent and the waiting felt like gambling. What he did not model was how pulling $22,000 per year from his traditional IRA on top of his reduced benefit would push his combined income past the $44,000 threshold, turn 85% of his Social Security taxable, and cost him an additional $3,840 per year in federal taxes he had never anticipated. The spreadsheet he was staring at that October morning was not a planning tool. It was a damage report. The dominoes keep falling, and once they start, the only question left is how many years of compounding damage you accumulate before you understand what set them in motion. The real cost is not what you pay in any single year. It is what you pay cumulatively over 15 to 20 years of retirement when your withdrawal strategy is misaligned with your tax map. If Gerald's uncoordinated approach costs him an extra $5,200 per year in combined federal taxes and Medicare surcharges, and that overpayment persists for 18 years, the math produces a lifetime cost of $93,600 in avoidable taxes, money that could have stayed in his portfolio compounding at market returns. That is not a rounding error. That is a second home, a decade of travel, or a legacy for grandchildren, gone to a tax bill that was never inevitable. Between the year you retire and the year your required minimum distributions begin at age 73, there exists a window that tax planners call the golden window, and it is the single most valuable stretch of time in your entire retirement tax strategy. During this period, your taxable income often drops to the lowest level it will ever reach, because you have stopped earning a salary, but the IRS has not yet forced you to withdraw from your traditional accounts. Most retirees treat this window as a vacation from financial planning. They coast on savings and Social Security and enjoy the quiet. What they miss is that every year the lower tax brackets sit unfilled during the golden window is a year of cheap tax capacity wasted, capacity that the IRS will force you to use later at higher rates when RMDs begin. The contraintuitive strategy is to deliberately convert traditional IRA dollars into a Roth IRA during these low-income years, paying tax at your current low bracket to permanently shield those dollars from ever being taxed again. If you are in the 12% bracket and you convert $40,000 of traditional IRA money to Roth, you pay $4,800 in federal tax today. But that $40,000, plus all of its future growth, will never appear on a tax return again. The math is asymmetric in your favor. You are paying a known low tax rate now to eliminate an unknown, likely higher tax rate later. Run that conversion annually during the golden window, and over 7 or 8 years, you can shift $280,000 to $350,000 into Roth territory at bargain rates. Most retirees who discover this strategy wish they had heard about it the year they retired, not 5 years in. Each dollar you convert from a traditional IRA to a Roth IRA is a dollar that leaves the pool of money subject to future required minimum distributions. A smaller traditional balance at 73 means smaller forced withdrawals, which means lower taxable income in your 70s and 80s, which means lower Medicare premiums and less Social Security taxation. The effect is recursive. Every conversion shrinks the future problem from multiple directions simultaneously. Once converted, those Roth dollars grow tax-free and come out tax-free, whether you withdraw them at 75 or leave them to a beneficiary who inherits them at 95. The quiet truth is this: the retirees who pay the least in lifetime taxes are not the ones who earned the least. They are the ones who filled every cheap tax bracket in every low-income year before the IRS filled those brackets for them. Your claiming decision, your withdrawal sequence, and your conversion timing are not three separate choices. They are one recipe with three ingredients, and the order you add them changes everything. Paying taxes early on purpose sounds wrong. That is exactly why it works, because the math rewards what intuition rejects. Patricia retired at 61 from a hospital administration role in the suburbs outside of Charlotte, North Carolina. She has $612,000 in a traditional 401k that she rolled into a traditional IRA, $38,500 in a Roth IRA from sporadic contributions over the last decade, and $87,200 in a taxable brokerage account holding index funds. Her Social Security benefit at 62 is $2,140 per month, and her annual living expenses, mortgage, insurance, groceries, healthcare, everything, run about $54,800 per year. She filed for Social Security the month she turned 62 because she wanted the income flowing immediately. With her Social Security providing $25,680 per year, Patricia needs roughly $29,120 more to cover her expenses, and she pulls it entirely from her traditional IRA because that account has the most money and it feels like the obvious source. That $29,120 stacks on top of her Social Security, pushes her combined income well above $44,000, makes 85% of her Social Security taxable, and lands her with a federal tax bill of roughly $4,370 that she did not see coming. Nearly $365 per month vanishing into taxes she could have reduced. Your situation might be closer to Patricia's than you think. And if you have been drawing from your traditional IRA as your default funding source without checking the tax cascade, you are likely paying the same invisible premium she is. Year after year, she follows the same pattern, and year after year, the tax bill quietly compounds. Kenneth is also 62, recently retired from a logistics management position near Richmond, Virginia. He holds $580,000 in a traditional IRA, $72,000 in a Roth IRA, and $95,400 in a taxable brokerage account. A similar total net worth to Patricia's, just distributed differently across his accounts. His Social Security at 62 would be $2,080 per month, and his annual expenses are comparable at $53,600 per year. Kenneth, however, does not file for Social Security at 62. He decides to delay his claim until 67, which increases his monthly benefit from $2,080 to approximately $2,950 through delayed retirement credits. During those 5 years of delay, he covers his $53,600 annual expenses by pulling $21,400 from his taxable brokerage account, where long-term capital gains are taxed at preferential rates, and the cost basis offsets much of the gain, and $32,200 from his traditional IRA, keeping his total taxable income low enough to stay inside the 12% federal bracket. His federal tax bill in each of those bridge years is roughly $2,860, more than $1,500 per year less than Patricia's, even though their expenses are nearly identical. On top of that, he uses the remaining room in his 12% bracket, approximately $28,000 of space, to convert traditional IRA dollars to Roth each year. Over the 5 bridge years, he converts $140,000 into Roth territory at a total federal tax cost of about $16,800, permanently removing those dollars from future taxation. Those Roth conversions shrink Kenneth's traditional IRA balance by $140,000 before RMDs even begin, which means when he turns 73, his required minimum distributions will be calculated on a smaller base and will generate less taxable income in his 70s and 80s. The math cascades forward. Smaller RMDs mean less Social Security taxation, lower Medicare IRMAA risk, and a larger tax-free Roth balance growing untouched. If you still have room in your 12% or 22% bracket this year, and your income is temporarily low, this is your window. And every January 1st that passes without a conversion is capacity you cannot get back. The cumulative benefit of those 5 years of strategic withdrawals and conversions will follow Kenneth for the rest of his life. Over a 20-year retirement horizon, the difference between Patricia's approach and Kenneth's approach is not subtle. It is a projected $142,300 in cumulative tax savings, factoring in federal income tax, Medicare IRMAA avoidance, and reduced Social Security taxation. That gap does not require Kenneth to earn a single dollar more, live a single year longer, or take a single additional risk. It emerges entirely from the sequence and timing of the same dollars. The recipe was always there. Kenneth simply added the ingredients in the right order. The first thing to do is pull your most recent Social Security statement from the SSA website and write down your projected benefit at 62, at 67, and at 70 in actual monthly dollar amounts. Place those three numbers side by side and calculate the annual income each one provides, because you need to see the real spread in dollars per year, not just the monthly difference. That spread is the foundation of every calculation that follows. If you are married, pull your spouse's statement too, and lay both sets of numbers on the same page. The second step is to map every source of retirement income you will have in your first year without a paycheck. Social Security if you claim it, pension if you have one, rental income, part-time work, dividends from your brokerage account, and add them up into a single annual number. Then subtract that total from your annual expenses to find the gap, because that gap is the amount you need to withdraw from somewhere, and the account you pull from determines how much tax you will owe. If your gap is $28,000, you need to know whether that $28,000 is coming from a traditional IRA, a Roth, a brokerage account, or some combination, and in what order. Write those sources down with their tax treatment next to each one. The third step is to fill that gap using the most tax-efficient sequence, which for most retirees means drawing first from taxable brokerage accounts, where long-term gains are taxed at lower rates, then from traditional accounts only up to the top of your current bracket, and saving Roth withdrawals for years when your income is unexpectedly high, or when you need a large sum that would otherwise push you into a higher bracket. Once you have covered your expenses, look at how much room remains in your current tax bracket and consider converting traditional IRA dollars to Roth to fill that space. This is the conversion opportunity that disappears once RMDs begin at 73. Calculate the federal tax cost of each conversion dollar at your current marginal rate and compare it to the rate you are likely to face once RMDs force larger withdrawals in your 70s. The fourth step is to run this entire calculation before December 31st of each year, because Roth conversions and tax bracket management are annual exercises that cannot be done retroactively once the calendar flips. Your next move is the most important one. Before this year ends, you owe it to yourself to sit down with a CPA or a fee-only financial planner who can model your specific numbers across a 20-year projection. A single planning session that costs a few $100s can save you tens of thousands over the course of your retirement. Do not let another low-income year pass without filling the brackets that are available to you right now. Gerald eventually sat down with a tax-focused financial planner the following January, 3 months after that early morning at the kitchen table in Columbus. What the planner showed him was not a single mistake, but a pattern of small, compounding misalignments. Early Social Security, combined with full traditional IRA withdrawals, combined with no Roth conversions during 3 years of low income, he had already burned through without realizing their value. He could not undo the claiming decision, but he could restructure his withdrawal sequence for the remaining years and begin converting traditional dollars to Roth in the bracket space that still existed. The planner estimated that even starting late, the adjustments could save Gerald roughly $47,600 over the next 12 years. Gerald said the thing that surprised him most was not the math. It was that nobody had ever laid out the connections between his accounts, his Social Security, and his tax brackets on one single page. The recipe for a secure retirement was never about finding one magic ingredient or one perfect moment to claim. It was about understanding that Social Security, tax brackets, Medicare premiums, and withdrawal sequencing are all ingredients in the same dish. And the order you combine them, the temperature you apply, and the patience you bring to the process determine whether the result nourishes you for 25 years or leaves you hungry halfway through. Your early 60s are not just a transition. They are the season when every ingredient matters most, because the flavors you set now are the ones you will taste for the rest of your life. Drop a comment below and tell me this. Are you currently in that golden window between retirement and 73? And have you started thinking about Roth conversions? Or is this the first time you have heard the strategy laid out this way? If this changed how you see your Social Security decision, leave a like so more people in the same situation can find it. The best financial move you make this decade might not be an investment. It might be a sequence.